Hey everybody, happy Tuesday. Today I want to talk about something known as notional value. When you get allocations from folks, they may have say like 20 million in the market and they give you $1 million. So they might also give you instructions though that although you only have $1 million, they want you to trade it as if it's 10 to 20 million dollars. So this brings in the concept of notional value. So what you might find is that when you do that, your margin to equity ratio looks like it's going through the roof. If you're working in like a wirehouse and someone has allocated X amount of money for alternative investments or what have you, you might find that they put in, say, anywhere between 1 and maybe 5% of their allocation to those style investments, which could include anything from private equity to this and that, or to managed futures. And so when you look at that, if they had 20 million, they put a million into alternative space, into managed futures. Of that $1 million, you might find, first of all, margin to equity ratio is not a risk management tool. It's just a barometer, like looking at what the temperature is outside. If you went outside and said that it's 85, to certain people that's hot. To certain people who live in much more warmer weather, it's temperate and it's moderate. So you might find that there's, I don't know, between 100 and 150,000 of that capital, committed to margin, initial margin for those positions. The rest is cash or treasury bills. It's dry powder. And that would be considered, on the spectrum of being, say, more aggressive. Again, though, margin is not a risk management tool. It's a number that the exchange comes up with that takes into account, volatility. There's a calculator they use called SPAN, S-P-A-N. I don't remember what it stands for. I used to know, but you could look it up. And it takes into account, again, volatility and also what month you're trading, right? Because if the volume and the open interest is in more in the front months, the further months or the more distant months don't have as much activity. So there could be illiquidity. So they might, change the margin levels for different months. So you can actually look all that stuff up. I don't have to waste your time here with it. But nonetheless, the same person might say, well, I actually have 20 million. So I have to look at all the allocations that I'm making. Maybe I'm taking 20 million, I'm dividing it up, 4 ways at 5 million apiece. I have to tell each of those commodity trading advisors to think of it like 20 million. So it can, in fact, create, kind of like leverage inside the account because you're trading it larger. You might also see larger, whipsaws in your capital because that person might have 50 to 70% of their cash, tied up in margin because they're trading the account as if it's actually bigger than the amount of money that's in the account in and of itself. So if you're getting allocations or you're trying to work with a funded account where you have a certain amount of buying power, not necessarily the actual money in the account, you have to really think of it as the same. Like, what of that buying power would you actually put to work? What would be sensible? In modern times, you have this day trading buying power where you can trade intraday up to 4 times. Again, I talked about day trading and short-term trading. I wouldn't do it if I didn't have a feel, because that's really what it's about. It's not about indicators and chart patterns. It's about, do you actually have a feel for the markets? It's kind of like knowing how to catch a wave and surf. So, be aware of that. I would look at, whatever your buying power is, you'd probably want to go on the more conservative side. So if you had $1 million and they said you could do Reg T is 2 million, day trading buying power could be up to 4, you'd still want to say, and base your risk on what you actually have in the account or the smallest amount. You see, because typically, again, when it comes to drawdowns, what you don't lose, you don't have to earn back. So buying power can be a lure to get you to do bad things or to do things that are unsuspecting to you. And again, I want to say it. If you're day trading or swing trading, you really need to have a feel. The shorter term you go, and don't start with me on zero DTE options. Like, what a sucker's bet. Like, my goodness. It never surprises me what Wall Street invents to try to separate people from their money. It's just unbelievable. So, and I don't want to get into it because people start taking the shit personally. But, again, I'm a person where I like to give myself more time to be right. So I normally think longer periods of holding because when I'm wrong, I'm typically early. Well, what happens when you're early and you're buying a weekly option on a Tuesday and it expires Friday, but your idea doesn't work out until like the following Wednesday, right? I didn't give myself enough time. So now I have to make a decision like, am I emotionally invested in the outcome? And that's why I'm putting on the second trade with a different option because the one that I was in expired. So notional values can come up in options, obviously. Typically, it's if you're trading equity, it's obviously the strike price times the number of shares times the number of contracts. That's typically the notional value of the option. In futures land, it's the same thing. It's the price of the commodity multiplied by the standardized unit. So that would be the notional value. Then you can see the percent margin by just going in and seeing what does the exchange require for margin and what is that as a percentage of the notional value so that you can see what the percent margin is. It's kind of interesting. It's not really risk management. So again, I would understand what notional values are, but unless your allocator is dictating the terms with which you're supposed to trade the money, I would always default to the smallest amount or the lowest value of it. Because if you're going to start to use leverage, which notional values kind of do, for your own trading in the account, it might destabilize you. Because if you had $1 million that you were trading like five, what's your 0.5% risk unit, right? It's 5 times larger than what you might do if 0.5% of $1 million is 5K, but the allocator is telling you to trade it like even twice, even 10. Now, the risk unit that you're used to for your trading is different. It's more aggressive. So with that larger trading size, you will see larger swings in the equity, right? I don't typically get excited about leverage. I'm not a risk lover. I'm kind of like, I look at it the same way a fireman would look at fire. They're not arsonists. They're not fire lovers. They're just better equipped to deal with it than you are. So that's the way I look at margin and risk management and stuff, is that I look at it from all these different angles, knowing that margin, etc., amplifies. It's a sword that cuts both ways, right? It amplifies your gains, but it also amplifies your losses. And if you define yourself as a day trader, swing trader, whether you're trading options, equities, or commodity futures in a bank foreign exchange, you're a risk manager by virtue of adding and removing risk. And the job is, even though you're trying to make money, your ethos and your mindset is playing superior defense. You come to the market always trying to define what the worst case scenario is. You know you have to be in it to win it, and you know you have to be in it to experience it so that you can develop or hopefully develop a feel. I know folks who have done it for years and they haven't developed a feel, which is why I say just switch to longer term trading, because you don't need as much of a feel, for that style of trading, nor for investing, in my opinion. So be careful of all those definitions and don't get enticed to use excessive amounts. Well, excessive is a biased term. I would look at that as excessive leverage, especially on the day trading buying power. If you can't trade and make money with cash, with that, like, say at $1 million, if you can't take 100K of that and make money with the 100K, not even fully exhausting the full account balance, why in the name of God would you be trading even with Reg T, never mind day trading buying power? Again, these rules have come up over the years that are not in the individual's best interests. They appeal to greed. They appeal to, again, the intellectual side of the world, which has nothing to do with the person's ability to pull stuff off, right? Trading is tactical, and it's about having a good feel. And there's really no book you can write about having a good feel. I can explain to you what I feel like in my body when I have a good feel. And I tried to capture that in the Inner Voice of Trading. I did nothing but delineate all my failures on what I needed to go through, which were numerous, in order to get and develop a feel. So, and it took me a long time. It took me over 4 years to kind of make money, but also understand myself, which is number two, right? Make money is one. Number two is better understand myself. And then the third part, which is kind of like a macro part, understand that I actually did have a feel. That realization doesn't come overnight. You can intuition yourself into thinking like, yeah, I got to feel like, look at all this money that I made. But in the short run, the data are very random. So I always tried to be more mature and not like the typical idiot guy and discount all that and say, okay, what if I'm wrong? What if I'm lucky? What if I'm in the right place at the right time? I'll take it because I have to take the bad luck too and the bad timing, the thick with the thin, right? So I always just tried to discount my ability because it also kept me super humble and kept me focusing on defense. So for those of you out there, especially if you don't have a lot of money, you might be trying to get yourself to the 25K so that you could trade it like 100K. I would say don't. That's not even flashing yellow. That's a flashing red. Because if you can't make money with the money that you have, then using leverage is an absolute no. There's no point in doing it because it's only going to open you up to losing higher percentages of your capital. Learn how to trade with cash and absolutely simulate as much as you possibly can to know and to try to define what your edge is, at least from an expected value standpoint. Then it only comes from the experience of putting on those trades that you can develop a feel, especially again for the short-term stuff. Anyway, I appreciate you all being here. I'll be here tomorrow with Ganja. We already have a lesson that we recorded a week or so ago. That'll be pretty good. And then I'll see you again on Thursday and Friday. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.